This is Mastering Your Wealth with David Gagnon, the podcast.
Glad to be back here with you. As we talk about each and every single week, there are so many things going on in the world right now. And sometimes planning for retirement gets pushed off to the side. And we want to bring it to the forefront. Right, David?
Yeah, people are seeing all the uncertainty that's out there with the markets and inflation and jobs. It's something that scares people from making that retirement decision. And I think you need clarity and having a plan to see no matter what's going on in the world, and you can avoid the noise that you hear, that you can follow a plan that's going to work out and let you head into retirement with confidence. So, that's what we do. We bring clarity in the financial planning process and implement planning strategies so that you can move on with your life, not worry about your money, and know exactly what you're doing and how it's going to work out for you throughout your retirement.
I mean, it's crucial right there to have that clarity and to have a plan in place. And when I say a plan, folks, I'm talking about something in black and white that you can hold. You see exactly where your money's going, what it's doing, how it's working for you, not against you. Not something that's just in your mind where you go, well, I think I know how much is in my 401k and I think I know this or that. That's not a plan. That's essentially an idea. And we talk about it all the time here, David. But let's discuss why it is so crucial, why it's so important to have a personal strategic plan when you're preparing for retirement.
Well, right now, people are following a plan of hope. They've worked all their lives. They've saved whatever they could. Their money's in different financial tools. And then they retire at an age they feel they might be okay because they're emotionally ready. They're not quite sure if they're financially ready, and that's the other component that you really need to make sure is going to work out. But they go into retirement. They make some mistakes early on. They don't have their money in the right places to create income. They might be in a portfolio that's market sensitive. It'll work okay until the markets don't. And so when the markets lose value and they're selling off shares at an accelerated rate to keep that same paycheck from coming in, now they're very vulnerable to depleting that retirement nest egg prematurely before the retirement's over. And so when you have a plan, it's like building a house. When you design a home that you're going to build from the ground up, you have strategic drawings, and it's going to be in what you want to see at the end of the day when that house is finished. The size, the appearance, the structure. And when you work off of a plan to build a house, you know exactly what materials you're going to order. You don't have overruns there because you know what it's going to take to build that finished product, that home, from the foundation all the way up to the finished work. Your money decisions should be based off a financial plan that's strategically aligned with your own personal goals, objectives, both short-term and long-term, that looks at all the moving parts to make you highly efficient in all the areas you should be efficient in. And when we look at a comprehensive plan, it's a big puzzle. Those puzzle components comprise your overall plan. So how do you optimize your Social Security as a strategy that you should carefully evaluate? That's an area I see costly mistakes. People just don't know how to pull the numbers and evaluate the strategies that work best for them. Your pension optimization is a strategy if you have a pension coming. Your income plan, when you get close to retirement, should be a strategic income plan that's aligned with what your income needs are going to require, and a tax plan. You should have a tax plan that doesn't defer your taxes in the future, but makes you very tax efficient in the future and mitigates taxes. And your investment strategy should be aligned with what your plan benefits identify that you need to create in the form of rate of return, income, tax efficiency, market mitigation. So you have some guardrails on your money, airbags on your money, so you don't get blindsided by the next market correction, and a healthcare strategy. So, there's so many things that go into a strategic plan, and when you know your numbers and you have a strategic plan, your decisions become very easy. So if you're interested in meeting with us to do a comprehensive plan, one of the things we will do complimentary is look at one of the components of what a comprehensive plan needs to have, and that is an investment plan strategy that's aligned with your planning objectives. And we'll do this on a complimentary basis so we can see if, in fact, your money is invested in the appropriate places to mitigate risk, increase your yields, is cost efficient, and has some tax planning opportunities. Because that is an area where I see people are way out of line with their investments. When they tell us what they want to accomplish with their long-range planning, we find that their investments do not align with their tolerance for risk, their income needs, their capital preservation objectives, their growth objectives, and tax planning. So this is something we'll do complimentary, and you'll see how things can be done differently to create better results and have better predictability with doing things that are outside the norm. We're not using mutual funds. We're not using ETFs. We're using strategic, institutionalized planning opportunities that the wealthy people actually use, and that's why they're wealthy. They're doing things differently. So we want our clients to take advantage of doing things differently so they get a better outcome. So if you want to have that complimentary portfolio analysis, give us a call.
And again, that phone number, 203-872-0009. That's 203-872-0009. If you're looking for that personal strategic plan, the first place to start is right here for a portfolio review. That's 203-872-0009. That website, masteringyourwealthradio.com. So apparently on Wall Street, there is a term called dumb money. It actually refers to casual investors who pile into the market late, buying as prices rise and headlines get loud. Historically, when that money rushes in, seasoned investors start heeding for the exits because of a downturn that could often follow. We may be seeing that right now because for decades, the average casual investor kept about 36% of their portfolio in stocks. And today, that number is a record high of 55%. So have you seen anything like this signal hold up before? And is this something that you're watching and aware of right now?
This is one of those indicators that doesn't get a lot of attention from everyday investors, but professionals watch it very closely. And historically, yes, it has held up surprisingly well. The reason is behavioral, not technical. When markets have been strong for a long time, confidence builds, headlines turn positive, and eventually the last group to get comfortable is the general public. What Wall Street refers to as dumb money. That's not meant to be insulting. It simply means non-professional investors tend to act later in the cycle. Now, I've seen this play out multiple times. And what's happening now, record high equity exposure is a signal that expectations are very high. That doesn't mean a crash is coming tomorrow, but it does mean future returns may be lower and risk is elevated. And this is where planning matters. We talk about planning all the time to keep you on the guardrails and have some airbags on your money. I think of a gentleman that came in a while back, and he came in after a long market run feeling confident and heavily invested in equities. On paper, everything looked great, but when we stress tested his plan under lower market return scenarios, it exposed a real vulnerability. So his plan only worked if markets kept cooperating, and you don't want to be in that position. So we made some adjustments. We rebalanced exposure to eliminate reliance on continued market risk. We built in income sources not tied directly to market performance, and we created a reserve strategy so he wouldn't be forced to sell during downturns. And then we focused on protecting what he had already built. So that's the key shift. Instead of asking what will the markets do next, we asked, does your plan still work if returns are lower than expected? So because retirement success isn't catching the last part of a bull market, it's about making sure you don't give it back. And so we can control certain things with a good strategic investment plan. And people are making too many decisions emotionally in how they're investing their money. We have to take the emotions out of the equation and make these financial decisions rationally and logically based on analytics and detailed analysis. And that's what really helped people figure out.
Again, if you'd like to come in for your own personal and complimentary investment portfolio analysis, call right now. That's 203-872-0009, 203-872-0009. Of course, that website, masteringyourwealthradio.com. So think about this, guys. When's the latest you should see a financial advisor? I'm sure lots of us have different opinions, but Morningstar put that question to Emily Guy Birkin, author of The 5 Years Before You Retire. And here's what she had to say.
So 5 years is an amount of time that feels real. The finish line's on the horizon. Oh, wow, this is really happening. But there's still enough time that you can really make a big difference. So focusing on that 5-year time frame is kind of like the perfect time to kind of strike while the iron's hot. It gives you enough time to make some necessary changes so that you're well positioned to have the retirement that you'd like to, or at least close to it, rather than, if you're panicking the year before or even 3 years before.
All right, so I know everyone's got their own timeline. Some may come super early, 5-10 years away. Some may wait and say, hey, in 6 months, this is what I'm going to do. So in that first meeting, David, what does it look like with a client before retirement, right? And then what if they get 5 years out, 10 years out? What if somebody comes to you and they say, I'm just a few years away?
The earlier people start seeking professional advice with their planning decisions, the better, because it's a very complex world. And what I see is the younger folks that I've worked with going back when they were younger are much better positioned because they didn't make the costly mistakes throughout their working years and didn't wait till they're 5 to 10 years from retirement. I have this one couple that came to me going back 34 years. They were in their late 20s. And the wife is self-employed and her husband is an entrepreneurial type. And they wanted guidance along the way. They were my tax clients back when I had my tax practice. And when we began doing comprehensive planning, they came on board. So we put together a strategic plan based on their long-range planning objectives. And they followed my advice to the T. They wanted to learn and they could implement. And to this day, now, he tragically died about 10 years ago. We had a plan for when that event could possibly occur. So we had a backup strategy when a spouse is lost because they were both income earners. And to this day, she is in a financial position like nobody else I have in my practice that is going to be taking out high six-figure income, tax-free.
Wow.
Because we were able to help her prevent the costly mistakes that the masses make by not having tax diversified how they invested and how they accumulated their money for retirement. And so we were able to help them and prevent them from making those costly decisions that people are making by following cookie cutter advice, following the masses, tax defer everything. And that's creating a big problem for a lot of people. So along the way, we were able to make sure they made good investments because they were buying real estate, rental properties. We analyzed each purchase to make sure they were getting a good deal and that was going to be a favorable investment in their overall plan. We structured things so that they put the right of money in and were tax diversified along the way, because if you know the tax code and you know the financial tools and how to integrate the two together, you can be in retirement and pay no taxes. I don't care what kind of income. People complain all the time how the wealthy don't pay their fair share of taxes. Well, it's because they're using folks that know how to utilize the tax code to create those tax benefits, those tax advantages. They're not breaking any laws. They're just following sound planning advice. And so when people say, how soon before retirement should we start seeking help? The earlier, the better. Because if you're 5 years away, and we do your forecast based on what you're presently doing, what I see quite often, especially if somebody has a pension and they put money in pre-tax retirement accounts, they are going to be exposed to a tax torpedo when they hit their required minimum distribution age, when they have to take money out of their qualified retirement accounts, whether it's IRAs or 401ks. And it might be age 73 for some folks, might be 75. But if we look into the future with what you've done today, we see these problems now. We can start doing some tax mitigation strategies and maybe do some Roth conversions, Roth alternative conversions, but it's going to be painful for small gain later. Whereas if we worked with that same couple earlier in life, it'd be small pain for big gain later. So I think people, the sooner they figure out their plan and actually evaluate what they're doing, the better the opportunities will look later if we are able to strategically change things for the better.
For more details or to sit down with David for your complimentary financial GPS, visit masteringyourwealthradio.com.
Investment advisory services offered through Brookstone Wealth Advisors, LLC, BWA, a registered investment advisor and an affiliate of Brookstone Capital Management, LLC. BWA and First Financial Planners are independent of each other. Insurance products and services are not offered through BWA, but are offered and sold through individually licensed and appointed agents.
Information provided is not intended as tax or legal advice and should not be relied on as such. You are encouraged to seek tax or legal advice from an independent professional.
Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and are not offered by Brookstone.
David Gagnon and First Financial Planners are not affiliated with nor endorsed by the Social Security Administration or any other government agency.
Registered investment advisors and investment advisor representatives act as fiduciaries for all of our investment management clients. We have an obligation to act in the best interests of our clients and to make full disclosure of any conflicts of interest. Please refer to our firm brochure of the ADV 2A Item 4 for additional information.